statement of cash flows. All right, so first of all, little review, assets equals. Now somebody tell me what all those three elements are. Assets are everything the company owns that has future economic value. What the heck does that mean? What's economic value? What does the economy do? We buy and sell shit in the economy, right? Okay, so it has future economic value. It has value to be bought and sold in the economy, right? So assets, everything the company owns has the right to that can be bought and sold in the economy. Okay, good. All right, and then of course, two ways to finance assets, right? Companies have to have assets. Can't money unless you spent some money, right? Have to have assets. Two ways to finance them. What are they? Liabilities or debt and equity. Liabilities or debt and equity. All right. So we can borrow the money from outsiders, which is called liabilities.
And this is two ways to what?
Two ways to finance assets. With debt, which is liabilities. So borrowing money from outsiders or from insiders, right? Which is called owner's equity. Okay. So assets equals liabilities plus owner's equity. So what is the accounting equation saying to you? That's how we finance assets, either with debt or with equity. Okay. Equity comes from two places. It either came from, oh, I don't have any pockets. Where does it come from? Out of the pockets of the owners, thank you. Or what's the other place it can come from? It's earned by the business, right? What's the other part of it? Capital plus retained earnings. What's retained earnings? Everything the company earned when? From the beginning of its life until now, the balance sheet date, that we have not paid out as a dividend. Okay, what's the formula for retained earnings? Beginning retained earnings? Let's do the plus first, do the good stuff first. Beginning retained earnings plus net income minus dividends equals ending retained earnings. Good. Okay. Good. 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 Hopefully that's getting in there. It sounds like some good test questions right there. All right. Okay. So on the income statement, remember we had to do these things in order. Why did we do the income statement first? What we find out at the bottom of the income statement? Net profit or net loss. Okay. So we need to know that so we can do what? Statement of retained earnings, because what was the formula again? Beginning retained earnings plus net income or net profit, or if it was a loss, minus net loss, minus dividends equals ending retained earnings. So we have to do the income statement first so we can find out the net income so we can do the statement of retained earnings. Why do we do it second? Why do we do the statement of retained earnings second? Very good. We need retained earnings for the balance, ending retained earnings for the balance sheet. Good, 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 good. What's on the balance sheet? What accounts are on the balance sheet? Assets and liabilities and equity. Good. Okay. So that's why we call a balance sheet, right? What do assets equal? Liabilities plus owner's equity. So that's why it's a balance sheet. It balances. All of our assets is still equal to everything that we own. Okay, forever. Okay, we have to balance. All right. So the statement of income, revenue is recorded, and we talked about this, as it is collected. No, earned. Revenue is recorded as it is earned. Would it make sense to do an income statement only showing the monies that you collected during the period? No. For example, if I am doing a huge job, maybe I'm an architect, and I'm doing a huge job, and it's a $50,000 job, and I've been doing it over the last 3 months, and I don't get paid until the beginning of the 4th month, what's going to be my revenue for those previous 3 months? Nothing, right? Because I didn't collect anything. So it makes more sense to do an income statement showing everything that we have earned during the period, not what we've collected. Does that make sense? Because it doesn't give me a good indication of how much I earned or how much my net profit or net loss if I'm recording the revenue as it is collected. So we have to record the revenue as it is earned. Okay, so remember that when you're looking at a statement of income and you're looking at the revenue, that's how much they earned during the period, whether they collected it or not. Okay, does that make sense? So it's how much we earned. And then what are expenses? Everything that it cost us to earn that revenue. Okay, does that make sense? So we have in accounting, we have what we call the matching principle. We match the expenses in the period with the revenues. So we're going to put the expenses on that income statement, even if we haven't paid them yet. Okay, we're going to record them as they're incurred. We incurred them in the same month that we were earning that money. So we match the expenses. So it doesn't mean if it says that we have $100,000 worth of expenses, it doesn't mean we paid that. It means that's what we incurred during the month. Okay? Okay, so when we see the net profit, that's really how much money we made. We haven't necessarily collected it yet, and we haven't necessarily paid the bills yet. But that's how much money we earned during the period. And that's what makes sense, right? So we're going to record it whether it's been collected or not. Everything that we earned, we're going to record all the expenses that we incurred this period, even if we haven't paid them, because that's what makes sense. That's how much money we actually made. And then by the by, we're going to collect the revenue and we're going to pay the expenses. Okay, so the statement of cash flows is going to reconcile the cash on the income statement to the cash in the bank account. So you've heard the phrase, show me the money, right? Well, that's what the statement of cash flow does. It shows you the money. I've actually stood before board members before. Most of them don't have a clue about financial statements, right? They're usually just a bunch of old geezers who got a few bucks in their bank account so they get put on a board somewhere, whether they know what they're talking about or not. And oftentimes they don't. So you have to explain, well, we have a profit, but where's the money? So you have to point to the statement of cash flows. Well, this is why we don't have any money in the bank, even though we earned a profit, because we haven't collected it yet. Okay, statement of cash flows is going to show us that. Okay, so when we look at the statement of cash flows, so who are we doing? Livers. Livers Inc. Statement of cash flows. And remember the statement, all of them except the balance sheet have a range of dates, right? Because we want to know how much did we earn for what period of time? How much retained earnings changed for what period of time? How much cash flows changed for a period of time? But on the balance sheet, we want to know how much assets do we own on one day? How much do we owe on one day? Okay, so everything has a period that encompasses this statement, everything except for the balance sheet. So this is for what period of time? For the year ended 12/31/Y3. Okay. All right, so statement of cash flow. So we're going to show the change in cash for this period of time. Statement of cash flows has 3 sections. We have the operating section. We have the investing section and the financing section. Then we calculate the change in cash, add that or subtract that from the beginning cash, and that's going to equal the ending cash. Okay, and you want to learn this format. Okay, so man, we talked about the type of accounts, right? These are our types of accounts. Okay, kind of patient. And some of you, I was looking at your discussion boards and your posts over the weekend. Some of you haven't been posting. That's part of your grade. You need to do that. Okay, and some of you, a lot of you have posted, but did not comment on another student. the whole goal of the discussion board is not only are you going to do a little bit of research and you're going to post something, but I want you to read your classmates' post and comment on somebody's post. And when I say comment, I don't mean brag on. Okay, oftentimes I get a post that says, well, Megan, you did a really good job on that. That's not a comment. Well, that is a comment, but it's not a valid comment. A better comment would say, Megan, you did a good job on that, but let me just add that you didn't mention that you can finance with debt or equity, but debt's a little bit more riskier than equity. So you add something to the conversation. Okay, does that make sense? Do you have a question? Got it? Okay. All right. So these are our types of accounts. So what type of accounts goes in the operating section? We start out with net income or net loss if it's a loss. Okay. So start out with net income and we add depreciation or amortization. Depreciation is the using up of what? Of an asset. What type of asset? More specifically. A fixed asset. What are the attributes of a fixed asset?
Tangible, you use it. And
use it for how long?
For at least a year.
At least a year. Good, good. Okay, so a fixed asset also, what's AKA what? What's the other name for fixed assets? Prop. What's the other name for fixed assets? Property, plant, and equipment, right? Fixed assets, 3 attributes. They're tangible, which means we can touch them, they're long-term, and we're using them in the business, okay? And because we're using them in the business, they're getting worn out or used up, right? Which is what we call depreciation expense. Okay, good. All right, so depreciation is just an estimate. It's not an outlay of cash. So that's why when we're trying to calculate the change in cash for a period, we add depreciation back to net income. Because remember, we deducted it from net income on the income statement. So now, because it's not an outlay of cash, we're going to add it back to try to calculate how much cash we derived from operations. Okay. Okay, so we add back depreciation. Also, we add back amortization. Amortization is the using up of an intangible asset. So like a copyright or a franchise or a patent or something like that. So it's depreciation if it's a fixed asset, amortization if it's an intangible, which means we can't touch it. M-O-R-T-I-Z-A-T-I-O-N, amortization. Okay, all right, so let's start putting some numbers to this. So our net income is $500,000. Everybody see that on your income statement?
Say that again.
Amortization.
No, money.
Okay, the net income, so looking at your income statement there, your net income is $500,000. Plug that in. Okay, do we have any depreciation? Yes. So we want to add that back because that was not an outlay of cash. So in order to see how much we earn from operations, we add that back. No amortizations. We do have down there in other, remember what goes in other? Ancillary stuff, right? That's not a part of operations. So in order to take our net income to calculate how much we earn from operations, we have to subtract that gain. So gains get subtracted, losses get added back. So when you look at other, so that gain, I'm going to get rid of amortizations because we don't have any. So we subtract that gain from operations because remember it's been added into net income. So subtract the gain of $75,000. If it were a loss, we would add it back. Okay. Then the other accounts that go in here are current assets and current liabilities. What's the definition of current? Current assets are going to be everything that turns into cash or gets used up within 1 year or one operating cycle, whichever you call it. Okay, so If it's going to turn into cash or get used up within 1 year. So we're going to consider all the changes in current assets and the changes in current liabilities in this section. Investing is the buying and selling of long-term assets. The buying and selling of long-term assets. And then how we finance assets? Long-term debt or owner's equity. Okay. All right, so the next thing we have to do is we look at our current assets, and they're listed on the balance sheet in order of liquidity. So the current assets are going to be the very first ones. Is cash or is going to turn into cash within a year? It is cash. What about accounts receivable? Turn into cash within a year? Yes. What about inventory? Turn into cash within a year? It's better, right? Unless you're building space shuttles. Okay? Because we got to have that money, right? We got to get that money back into the operating cycle. Good. Okay, so those are all current assets. Investments could be short-term, could be long-term. I'm going to assume that those are long-term. Okay? The investments are long-term. All right? And of course, in the real world, you would know. All right? So the current assets, cash changed, of course, but we're going to record that down here. We want to look at the other current assets and see what the changes are. Accounts receivable went up or down from last year to this year? Up, because it was 400,000 in Y2, it's 450,000 in Y3. So accounts receivable went up. So we're going to say increase in accounts receivable. So if accounts receivable went up, is that a source of cash or use of cash? Does that mean we collected more than we sold, or we sold more than we collected? If accounts receivable went up, people owed us $400,000 at the end of last year, and then they owed us $450,000 at the end of this year. So that means that we sold more than we collected, right? And remember, the sales are in net income. So if we want to reconcile net income to cash, our cash actually went down because of this. Okay? So an increase in accounts receivable is a negative number. We have to subtract that from net income in order to determine how much cash was derived from operations. Okay? Because we have sales included in here that we did not collect to the tune of $50,000. Okay? Make sense? And it'll come together. And some people just memorize it. If a current asset goes up, it's a minus, and if it goes down, it's a plus. You can do it either way. Okay, inventories, up or down? Up. Inventories was 750, and they went to 770. That's a current asset. So if the current asset went up, we bought more inventory, right? We bought more than we sold. What did we pay for it with? Cash, right? So that's a use of cash. So the inventory went up by $20,000. So that means that we used some of our cash to the tune of $20,000. Make sense? Okay, so that's all our current assets. Let's jump down and look at current liabilities. What are they? Accounts payable. Accrued expenses, those are things that we have incurred and not yet paid. That's the definition of an accrued expense. If I didn't know that, I'd write that down. Accrued expense, incurred, not yet paid. Remember what goes on the income statement? Everything that we incurred during the period. And some of them haven't been paid for yet. That's what we call accrued expenses. All right, so accrued expenses, they go up. Oh, let's see, accounts payable, did it go up or down? Okay, so if accounts payable went up to the tune of $40,000, so is that a source of cash or a use of cash?
Say that again?
Is that a source of cash or a use of cash? So that means I owe other people more money than I owed before. Okay, so I'm borrowing $40,000 from my vendors. Does that make sense? I have $40,000 worth of expenses that I have not paid yet. So I'm borrowing money from my vendors. So is that a source of cash? Yeah. Yeah, it is. Okay, I'm borrowing money from my vendors. And companies do that, especially young companies. They'll float themselves a few days by holding their vendors a little bit out there. You can do that to a certain extent. So increase in accounts payable is a plus. 40,000. Okay, does that make sense? So I'm borrowing for, customers are borrowing 50,000 from me. I'm borrowing 40,000 from my vendors. Accrued expenses, up or down?
Down.
They were 50 and they went down to 45. So if accrued expenses went down, I must have paid some of them, right? What'd I pay them with? Cash, right? So if accrued expenses went down, I must have paid them with cash. So that's a minus. That's a negative number. Okay, dividends payable, we're going to consider down here in financing. Okay, so don't worry about dividends payable. I'll put that down in financing. Okay, so that's all the current liabilities. So now we can total this up, and that's how much cash that we derive from operations. So somebody want to do that for us? So we got 675, 715 minus 75,000, 640. Somebody said that? Yeah, I can always count on White. He keeps me on my toes. So cash from operations is $640,000. Cash from operations. Okay, does that make sense? So my income statement said I earned $500,000, but how much cash did I actually get from operations? $640,000. Okay. All right, so next, investing. So let's look and see, did we buy any equipment? And there's a little verbiage down there at the bottom. So it says investments were sold for $175,000. So what type of account is investments? Something we own? It's probably us buying stock or bonds in another company. Or it could be a piece of land. It could be any long-term asset, right? It's a long-term asset. So it says we sold those investments for $175,000. So where do long-term assets go? In investing. Okay, so how much money did we get from selling those investments? So investments, and it says I got $175,000 in cash. And that's a plus, because I sold those investments for cash. Then the next line says equipment and land were acquired for cash. So if I look back up there at my two balance sheets, it says equipment. Did it go up or down? It went up. So I had 1.2 million in equipment, and now I have 1.4 million in equipment. Remember that rule that says that equipment, all long-term assets stay on the books at historical cost? So I know that 1.2 million, that's what I had paid for the equipment that I had. And then of course in 20Y3, I have $1.4 million worth of equipment, and that's cost, all right? So I spent $200,000 buying equipment. Does that make sense? Buy equipment. Plus cash or minus cash? Minus. I spent some of my money. What about land? Did I buy some land? What happened to land? It was zero. Now it's half a banana, right? Okay, so how much did I spend on land? Half a banana. What's a banana? A cool million. Okay, so I spent half a banana on land, and that was cash. All right, and that's all my long-term assets, investments, land, and equipment. They said I didn't dispose of any equipment or land during the year, but I didn't have any before. Okay, so I didn't dispose of any equipment. So all that $200,000 was buying new land. And then it says I sold common stock for cash. I issued common stock or I sold owners, maybe I got some new owners, or maybe the old owners bought some more stock from me. So the way, and of course, on the exam, I'm not going to ask you to do something that's complicated, so I'm just going to tell you how much did we spend for stock. So it's the common stock account went up by $100,000, and the paid-in capital account went up by $25,000. So you have to consider both of those, the common stock and the paid-in capital. Remember, capital has two parts. It was paid in by the owners or it was earned by the company. A company will separate their par value of the stock, goes in the common stock account. If they sold the stock for greater than par value, it goes in additional paid-in capital. So that's the additional that you got for the stock above the par value. What's par? What's par in golf? Even, okay? In stock, par value is the minimum. So a company cannot sell their stock below par value. That's the minimum legal capital for that stock. They can never sell it below par, but they can sell it above par. So if they sell it above par, they put the additional monies in additional paid-in capital. So anytime I want to look at a balance sheet and see how many shares of stock are outstanding, I can look at the common stock account and divide it by the par value, and I can tell you how many shares there are outstanding because of that rule. Okay, does that make sense? So common stock is always the par value. Additional paid-in capital is the additional amount of money I got when I sold that stock. Okay, so in order to determine how much did I get for that stock when I sold it, I have to add the change in both accounts. So I can tell my common stock account went up by $100,000. The par value is $4. So how many shares of stock did I sell? Somebody said it. 25,000. Okay, does that make sense? At $4 a share. Okay, so the change in the common stock account divided by the par value, I sold 25,000 shares of stock at, well, actually I sold it at $5 a share, right? Because $25,000 went into the additional paid-in capital. So it was $4 par and I sold it for $5 a share. And that's a little complicated. Don't worry about that. Okay, we're just worried about where the money came from. And I'll tell you that on the test. I will tell you that you sold stock for $5 a share. Okay, so we're going to say sold stock. Was that plus cash or minus cash? Plus. Okay, because we got money for that stock. And then what about long-term debt? Did it increase? We have no long-term debt. Okay, so never mind. Okay, but we did declare a dividend. And we paid a dividend. Notice I've written out to the side, and I'll give you that information. Not going to ask you to figure that out. That's a little bit more advanced. Make accounting majors do that, but not business majors. Okay, so it says we paid a dividend of $85,000. And that's an owner's equity account, right? Dividends are an owner's equity account. So paid dividend, $85,000. Of course, we paid that with cash. Okay, now we've considered everything. So we looked at all of the different types of accounts. And now we can determine where our money came from and where it went to. All right, so this section was at 500,000 or 700,000 rather minus that. So 525. See, I'm looking at white because white is like a computer. So cash used. So remember, this was cash from operations because it was plus. So I'm going to say cash used in investing was $525,000. Okay, and in financing, so a positive 40,000. So this is cash from financing is a plus 40,000. So my change in cash is what? 115, 155. So that's my change in cash. Cash went up $155,000. Make sense? And I started out with how much cash? If I look at the balance sheet, how much cash did I have at the beginning of the year? 150. Okay. Okay, at the end of Y2, which is the beginning of Y3, I had 150. So I had 150, add that to my change in cash, so what, 305? What on my balance? Change in cash should have been 5,000. Oh, the sale of investments. No, I got that.
Where'd you get the plus 155,000?
Adding together my three sections. Why? I'm off by $150,000. Oh, no,
okay.
the change.
I see where you, so you added the 16.
So the change is 5,000.
Yeah. Okay.
Or the change is 155. Now, my change has got to be 5 because my beginning cash is 150 and my ending is 155. So this is $5,000.
Yeah, you were confused. I didn't know what.
How did you get $80,000 for the cost of financing? Oh, shit. Because 125, track 85 is 40.
Oh, it's about plus 40. Who said that? 125 minus-
1,000 is track 85,000 is 40,000.
Yeah, that's what she wrote.
That's okay.
I thought it was 80, my bad.
Okay. All right. So, but I've got a mistake somewhere. Help me find it.
So you add all three of those numbers and it should give you.
Yeah, all three of those numbers should give me $5,000. So we have an error of $150,000 somewhere.
I know the numbers are right. Did we forget something?
We may have.
I didn't look.
All right, current assets. Accounts receivable increased. Inventories increased. Accounts payable increased. Accruals decreased. So I paid cash for that. Dividends are down here. And I sold investments 175. And I bought equipment, 200,000. I bought land for 500,000, so that's 700 minus that 525. Do what? Okay, then I sold stock, $425,000, I've got that.
She's recalculating everything.
And I paid dividends of 85,000,
So she's.
that's plus 400.
Keep getting. Yeah.
And that's-
She did too.
So that's 155,000, but it should be 5,000. Because my cash was 150 and it went to 155. So cash should have gone up by $5,000. I'm off $150,000. Where? Appreciation.
Did you do the, other operations?
I did everything.
Oh, the gain. I added it. I should have subtracted it.
What?
I have that on my paper.
I have it subtracted.
Okay, so this should have been,
Hey,
and I put my minus sign over here. I didn't put it over here. So that means this goes down to 490.
I wrote that on my paper and that squiggle it out and you plus it. Yeah, that's right.
Okay,
what does it end up being?
so 590. Oh,
590?
Should be 49.
thank you.
Yeah.
So that makes me 530 minus 525 equals 5,000. See? And we can find the error. So that was good. Anytime you make a mistake, right, you learn more.
Wait.
She was just checking her.
So I just had to go back up because I knew I was off. See, you should never, you should always balance your statement of cash flows because you know if you're right or not. So I knew I was off $150,000, so I just had to trace it back and see where my error was. And my error was that I added, we all added the 75 instead of subtracting it.
cash from.
Okay. Remember I said subtract gains and add losses. But I forgot, I put my minus sign over here instead of here, so then we added it instead of subtracting it. Okay, does that make sense? I am recording this, yes.
Please tell me we're doing this again on Wednesday.
We, yeah. Okay, and then what does it mean? What does it mean? So from operations, so now this changes everything, right? Our net profit said 500,000, but we only collected 490. So we'll collect the other 10, by the by. But we only got 490,000 from operations. We spent $525,000 in investing in long-term assets, and that's okay, right? Because that's investing in growth. So if I were to analyze this company, I'd say, pretty darn good, collected almost a half a banana from operations. I spent a little over half a banana investing in the future, right? Because if a company is buying long-term assets, they probably got confidence in the future. Okay, they're not having to rob Peter to pay Paul, right? They're not close on their cash flow. Financing, so I obtained $40,000 because I sold some stock minus the dividend that I paid out. So I got $40,000 from financing. So that taken all together, so my cash went up by 5,000, and I checked that by saying my beginning cash plus the change equals my ending cash, so I know that I'm correct. And does that make sense? So just by looking at the income statement, we can see how much money we made, but then this shows us why the cash only went up by $5,000. What happened to the money? So this is the statement that shows us the money. All right, I'm going to stop the recording and I'm going to check the roll.
What time do you work there, Laura? So this on the J's office, so this is the J's office.
I'm working on it.
Yeah.